Step into the world of investments with the classic book, The Intelligent Investor. This isn't just any book, it's one of the most influential books on investing ever published. It's a guide, a mentor, and a friend to anyone who wants to navigate the complex world of investments. At the heart of this book is the author, Benjamin Graham, often considered the father of value investing. His ideas and strategies have shaped the way countless investors approach the market. Among his many admirers is none other than Warren Buffett, one of the most successful investors of all time. Buffett has gone on record to praise The Intelligent Investor as the best book on investing. It's a testament to Graham's timeless wisdom and acumen. With that introduction, we've only just skimmed the surface of what this monumental work has to offer. Now let's delve into the wisdom that this seminal book has to offer. Chapter 1 distinguishes between investment and speculation. This is a foundational concept in Benjamin Graham's The Intelligent Investor. Now, you might wonder, what does this mean and why does it matter? Well, let's delve into it. Graham introduces us to the concept of defensive investing. This is a strategy that emphasizes safety over high returns. It's about preservation of capital and earning a satisfactory return rather than chasing the next big thing. It's the tortoise in the infamous race, steady and slow but ultimately victorious. Now let's contrast this with speculative or aggressive investing. Speculation is akin to gambling. It's the hare in the race, quick and flashy but often reckless. Speculative investors are attracted to the allure of high returns, often disregarding the inherent risks. This approach might earn you a quick buck, but it's not sustainable in the long run. For Graham, investing is a marathon, not a sprint. It's about the long-term orientation of investing. This means buying and holding on to investments for years or even decades. It's about letting compound interest work its magic, letting your wealth grow steadily over time. Graham asserts that this approach, coupled with a well-diversified portfolio, can lead to a more predictable and stable return on investment. Graham's Intelligent Investor is not swayed by market fluctuations or the latest trends. Instead, they are cautious, methodical, and patient. They understand that the market will have its ups and downs, but they remain steadfast in their strategy. They don't let fear or greed dictate their investment decisions. They focus on long-term wealth maximization, understanding that it's not about getting rich quick, but about building wealth gradually. It's about accumulating assets that will provide a steady income stream and grow in value over time. So, in essence, the intelligent investor, according to Graham, is not the one who makes the most money in the shortest time, but the one who consistently makes wise investment decisions that lead to long-term wealth. The intelligent investor, according to Graham, is cautious and focuses on long-term wealth maximization. In Chapter 4, Graham discusses the portfolio policy for the defensive investor. Delving into the heart of the matter, Graham proposes that the defensive investor should have a diverse portfolio. This means splitting investments between high-grade bonds and leading common stocks. Now you might ask, why this division? Well, the answer lies in the art of risk management. Imagine your portfolio as a seesaw. On one end, you have high-grade bonds. These are generally stable, dependable, but may not offer sky-high returns. On the other end, you have leading common stocks. These have the potential for astronomical growth, but they also carry a higher risk. When you balance these two, you create a portfolio that can weather the storms of the market and still come out on top. Graham emphasizes that this balance is not set in stone. It can shift based on market conditions. However, the essential principle remains the same. A balanced portfolio is a strong portfolio. Now let's talk about diversity. It isn't just about having different types of investments, it's also about having investments in different industries, sectors, and even countries. This is where the saying, "don't put all your eggs in one basket," rings true. By spreading your investments, you reduce the risk of one bad apple spoiling the whole bunch. Graham also recommends periodic portfolio review and rebalancing. This isn't about chasing the next hot stock or jumping on the latest trend, it's about maintaining that delicate balance, ensuring your portfolio aligns with your investment goals and risk tolerance. In essence, Graham's defensive investor is not the one who avoids risks, but the one who understands them, manages them, and uses them to their advantage. This investor doesn't aim for the stars in every investment but seeks steady, consistent growth. They understand that the race is not always to the swift, but to those who keep running. So as we wrap up this scene, remember this. Graham's defensive investor minimizes risks and maximizes profits. This approach, while not flashy or exciting, is designed for the long haul and the steady climb to financial success. Chapter 8 delves into the investor's relationship with market fluctuations. Here, Benjamin Graham opens up a discussion on the inevitable roller coaster ride that is the stock market. The market's volatility isn't something to fear, but rather, something to understand and, if possible, leverage to your advantage. Graham believed that the intelligent investor should not be swayed by market sentiments. He emphasized that the market is there to serve you, not to guide you. And while the market can suggest the best times to buy or sell, it is ultimately up to the investor to decide. One of Graham's most famous contributions to investment theory is the allegorical figure he called Mr. Market. Imagine Mr. Market as your business partner who turns up every day at your door, offering to sell his share of the business or to buy your share. This partner is subject to wild mood swings. On some days, he is euphoric and sees only bright prospects for the business, and on other days, he is incredibly pessimistic and sees only doom and gloom. Graham argued that the intelligent investor should not fall under the influence of Mr. Market's manic depressive behavior. Instead, they should benefit from it. When Mr. Market is overly pessimistic, that's the time to buy, and when he's overly optimistic, that's the time to sell. In essence, Graham was advocating for a contrarian approach to investing. Graham's advice is simple: don't let the market dictate your investment decisions. Instead, base your decisions on thorough analysis and sound judgment. This approach allows you to take advantage of market fluctuations, rather than being victimized by them. It's about remaining focused on long-term investment goals, not getting swept up in the short-term market hysteria. So, what's the takeaway here? It's quite straightforward. The market will fluctuate, that's a given. But as Graham so eloquently put it, in the face of market ups and downs, the intelligent investor remains level-headed. Scene script. Chapter 20 introduces the central concept of investment, the margin of safety. This is not just a phrase, but a philosophy, a guiding principle that defines the approach of a prudent investor. To put it simply, the margin of safety is the difference between the intrinsic value of a stock and its market price. This concept is a critical element in risk management. It's like a safety net, protecting you from the unpredictable flips and turns of the market. Imagine you're a tightrope walker. Below you is a safety net, a margin of safety if you will. If you fall, it catches you, preventing a disastrous outcome. In the same way, the margin of safety in investing serves as your safety net. If a stock doesn't perform as expected, the margin of safety is there to protect your investment. The larger the margin, the greater the safety. If you buy a stock for $50, which you believe is worth $100, you have a 50% margin of safety. This gives you a cushion against the uncertainties and the inherent unpredictability of the stock market. But why is this important? Well, investing is not about predicting the future. It's about managing risk. It's about making sound decisions based on the information available today, while also preparing for the unknowns of tomorrow. The margin of safety helps you do just that. It's important to remember that the margin of safety doesn't guarantee profits, nor does it eliminate the risk of loss. What it does is provide a buffer, a cushion that helps protect your investment against errors in calculation, unforeseen events, or simple bad luck. Benjamin Graham, the father of value investing, emphasized this concept heavily in his teachings. He believed that the intelligent investor is not the one who predicts the future, but the one who prepares for it. He understood that the future is uncertain, and the only way to navigate it is by ensuring a margin of safety in your investments. For Graham, the intelligent investor always ensures a margin of safety. Now let's summarize the key insights from The Intelligent Investor. This masterpiece by Benjamin Graham has left us with invaluable lessons. One of the standout concepts is defensive investing. It encourages us to be cautious, to not let emotions drive our investment decisions, and to always seek out a margin of safety. This book also emphasizes the importance of a balanced portfolio. It's not about chasing the next big thing, but about creating a mix of investments that can withstand the ups and downs of the market. Then we have the memorable Mr. Market analogy. It tells us that the market is like a business partner who offers to buy or sell his share of the company every day at different prices, which are often irrational. We should not be swayed by Mr. Market's moods, but rather make our decisions based on careful analysis and judgment. These principles lay the groundwork for a successful investment journey. The Intelligent Investor indeed is a treasure trove of investment wisdom. The book's significance is not just historical but also deeply practical. Benjamin Graham's principles remain as relevant today as they were when he first penned them. The wisdom in these pages is timeless, offering guidance that can shepherd both the novice investor just starting their journey and the seasoned pro seeking to hone their strategy. Graham's teachings underscore the importance of a disciplined approach to investing, a focus on the fundamentals, and a clear understanding of one's own risk tolerance. His insights remind us that investing is not about chasing the latest trends, but about making informed, thoughtful decisions. In the ever-changing landscape of the financial markets, Graham's principles are our compass, steering us towards sustainable, long-term growth. They teach us not just how to invest, but how to think about investing. Remember, in the world of investing, patience and discipline, as Graham teaches us, are key.